At Opportunic, we recognize that access to financial growth should be universal. This belief drives our commitment to creating a private wealth fund designed to unlock prosperity for Africans across the globe. Our focus is on making investment opportunities accessible, regardless of geographic location. With a starting capital of $1,000, the Opportunic Global Fund provides USD-denominated investment options to investors intending to build long-term wealth across generations. The Opportunic Global Fund, OGF, operates under CIMA regulation with headquarters in Mauritius and offices in Nigeria and Kenya, and is managed by a team of registered, experienced fund managers. Our investment approach centers on an alternative asset class strategy, targeting non-traditional assets to deliver consistent, robust returns. This approach mitigates exposure to currency fluctuations and political instability, providing our investors with greater investment security. Opportunic is a private fund, available exclusively to qualified investors. Learn more about OGF's 4 funds: Sahara, Sahel, Nile, and Zambezi. Visit www.opportunic.com. Prosperity awaits. Opportunic, Africa's global fund.
Good morning, afternoon, evening, everyone, and welcome to today's highly anticipated webinar hosted by Opportunic Global Fund. My name is Dino Nyambu, and I'll be your webinar facilitator for this insightful conversation. We're excited to have participants from over 22 countries with strong representation from Africa, North America, as well as Europe. Today, we're exploring the crucial impact of the US Federal Reserve's imminent rate cuts on global markets, particularly what this means for both mature and emerging markets. I am very honored to introduce our 2 distinguished speakers, Kola Oyeneyin, our CEO of Opportunic Global Fund, and John Stoltzfus, Chief Investment Strategist at Oppenheimer. John brings 41 years of experience and will help us navigate the implications of this market shift. Before we begin, we'd like to hear from you. Let's start with a few poll questions to get a sense of your outlook and expectations, which will shape today's discussion. Please feel free to engage. So let's move on to the poll questions. First question: what action do you expect the Federal Reserve to take during today's crucial meeting?
Well, Dean, it's a pleasure to be here, to be on this call representing Oppenheimer and Company. And I think that's a great question to start off. We expect the Federal Reserve will likely cut rates today by 25 basis points. There are expectations in the market, and the majority, I think, of the futures are pricing in a 50 bips or basis point or 0.5% cut in the Fed funds rate. But we think it's likely going to be 25. We think the Fed wants to make this a down payment for both Wall Street and Main Street in the US. To give them an idea, this is the beginning of the end of the Fed funds hike cycle. And the process is more likely to come as the Federal Reserve feels more confident in cutting rates?
Thank you, John. We actually wanted to push that to our audience before you come in, so that we can get a sense of what they think. So we have a few questions. We have a few questions for them, but at least they've gotten a taste of what to expect from you today.
All righty. Let me know when you need me to speak, if you will.
Well, I mean, now everyone's going to say 25 basis points.
Okay.
Well, so if you disagree with John, please go ahead. So, I mean, let's roll that poll question again. What action do you expect the Federal Reserve to take during today's crucial meeting? Well, cut by 25 basis points. No surprise, John, you influenced the vote there. That's election interference. So let's move on to the next question. What is your outlook for the S&P 500's net returns over the next 6 months? So increased by over 10%. Do you think it's going to be a move lower? So far, interesting mix of outlooks. Remember, your input helps shape the conversation, so please don't forget to vote. Will we see a strong rebound, continued volatility? I mean, something to think about. Historically, the S&P 500 has experienced gains in the months following the first Fed rate cut in previous cycles, though outcomes can vary depending on broader economic conditions. So it'll be interesting to see what the audience thinks. Okay. Keep voting. Okay, interesting. All right. So increase by 5 to 10%. John, I hope you're taking notes, what the audience thinks.
Okay, yes.
Majority of our audience thinks, increase by 5 to 10%. All right, let's move on to the next question. Which asset class do you expect to outperform in the next 6 months? So here we've got a mix of equities, bonds, and commodities. Do you think it's going to be US equities, emerging market equities? Is it going to be precious metals, gold? I mean, gold's a record high this year. Is it going to be copper? Do you think this is the time where we're finally going to see a transition to the super cycle? Okay, great perspectives coming through. I mean, different asset classes react in unique ways to market shifts. So, I mean, asset classes like precious metals often act as a hedge during periods of uncertainty. And, they do benefit from real yields. Equities tend to benefit from economic growth. Okay, interesting. Keep voting. All right, let's look at the results. Oh, great mix there. So it's between high yield bonds, so that rotation or reglobalization trade, emerging market equities, which also fits into that, as well as precious metals. Okay, interesting choices there. Let's move on. Next question. How do you expect regional portfolio flows to shift in response to the Fed's rate cut? Okay. Do you think we're going to see a massive move into emerging and frontier markets? No significant changes? Remember, historically, rate cuts in the US often lead to capital flowing into high-yielding assets. But, investor sentiment can be unpredictable. Keep voting. Last chance to get your vote in. Okay, let's look at the results. Okay. So between a slight shift into EM and FM and a large shift into emerging markets and frontier markets. Interesting. Final question. Which sector do you believe will benefit the most from advancements in technology and AI over the next 10 years? Is it consumer technology? Is it manufacturing? Is it healthcare? Is it energy, financial services? Keep your votes coming. I mean, AI is expected to transform industries in profound ways. So, I mean, while tech is an obvious benefactor, financial services, healthcare also set to reap massive rewards from AI advancements. especially in automation and efficiency gains. Keep voting. Last chance to get your final votes in. 5 seconds. All right. Let's see those results. Financial services, between financial services, consumer tech, and healthcare. Interesting, no one picked energy. Wow. All right. Thank you everyone for participating in those polls. I believe your insights have helped set the stage perfectly for today's discussion. Now we'll play a brief introductory video about John, Oppenheimer's chief investment strategist. After the video, the next voice you'll hear will be John's, as he takes us through how we've arrived at this critical moment in the global economic cycle, particularly as the Fed begins its anticipated easing phase. Once John has shared his thoughts, I'll return to hand things over to Kola, who will lead our conversation for the rest of the webinar. Let's go ahead and roll the video.
With over 30 years of experience in financial markets, John specializes in intermarket analysis across multiple asset classes, creating global market strategies that incorporate cyclical and secular trends, sectors, geopolitics, and macroeconomics. John is passionate about engaging in dialogue through question and answer sessions that foster strong relationships with Oppenheimer's clients and financial professionals. He also serves as an adjunct professor at New York University's School of Continuing and Professional Studies, where he teaches intermarket analysis and finance for non-finance professionals. John is the managing director and chief investment strategist at Oppenheimer, where he has been since April 2012. Ladies and gentlemen, please welcome John Stoltzfus.
Thank you very much. That was a very nice introduction. Appreciate it. I want to say thank you to all who have joined us in this call today. I've been in this business for 41 years, so I've been through every boom, bust, and recovery cycle since 1983. I came to this business at the time when Paul Volcker was chairman of the Federal Reserve. He was the Fed chair who had to bring down inflation from levels that got to such a high level that the 10-year Treasury at one point yielded nearly 16%, just under 16%. So that's where I've gone through a lot of different things and hopefully can add some context to the current situation. In our view, we look at this current cycle, the Fed funds hike cycle, which is hopefully going to begin to end today when we hear that announcement at 2 o'clock New York time from the Federal Reserve. I would say this, we've been through crisis situations really since 2007, 2008, the great financial crisis. And at that point, what we saw was a very dramatic change in the terms of the Federal Reserve when Ben Bernanke became Fed chair. Since that time, through the tenure of Janet Yellen and now the tenure of Jerome Powell, the Federal Reserve has been increasingly open, transparent, highly communicative, and been able to actually, if you think of some of the efforts, some of the actions of the Federal Reserve to be punches when they tighten, even telegraphing its punches or the sentiment towards punching to the markets. And the markets, curiously enough, in our view, really have most of the period have remained very untrusting of the Fed, even though in our recollection, from our experience, the Fed has been remarkably good at being able to curb inflation and practice its mandate to bring back a stable economy in the U.S. with inflation in check and unemployment in a range of 3 to 4%, which equates to what's called full employment, to allow for transitioning in the labor force. So where we are today is after 20 FOMC meetings before this one today, the Fed has been in a hike cycle over which it raised its benchmark rate from 0 to 0.25%. So essentially from free money to 0.25%. That was the band for most of the period for many years now, with a few intermittent periods where it did raise rates slightly. But effectively a free, very cheap money environment to now where the benchmark rate is 5.25% to 5.5%. In the process of that, really, it's the end of free money is what we say, and we add, we think it's a good thing. Well, it does increase the costs of mortgages, it increases the cost of doing business, the cost of margin expense by institutions and speculators that play in the markets. And what we would say is we think it's a good thing because essentially where we are today is we are in a period once again where bond issuers have to pay for the privilege of borrowing money. At one point during the last few years, major corporations and technology were able to borrow money sometimes for less than 1%. For relatively short periods of time. But you can imagine that free money, borrow money even when they didn't need it, it just made sense. If money's for free, why not borrow it? So where we are now, we think, is in a more realistic period. And we think the Fed will come off the boil in terms of the levels of where it has its benchmark rate now. Our expectations have been that it would cut 2 or 3 times in the second half of the year, where we are now, and that it would do that likely in increments of 25 basis points. So we're looking overall from here to the end of the year, 25 today, another 25 in November, and another 25 in December is what we're seeing. In terms of the way the markets have reacted to all this, overall, looking at what caused the inflation in the U.S. Is not so much the Federal Reserve's actions in the liquidity it provided during the pandemic, the COVID-19 crisis, but essentially the additional liquidity that was applied through fiscal policy by Washington, D.C. And we think that, it was in March of 22, the Fed had actually not thought that inflation would be as problematic as it became by 2022. And at that point, the Federal Reserve, jostled by the markets, we'll say, and alerted to it, realized it was behind the curve and began this tightening process. But now we've turned the corner. Now, I've addressed the Fed. Dean, what more do you need for me in this segment? Do you want me to give a viewpoint of the markets, how we think?
No, I think we can save that for the conversation with Kola.
All righty.
So thank you so much, John, for those valuable insights and that introduction. Kola, over to you for the discussion.
Hi, John. Just a mic check. Can you hear me?
Yes, can hear you very clearly, Kola.
Excellent. Well, once again, on behalf of Opportunic, I wanted to say thank you so much for joining and for making time out today. This is actually right now. I think you possibly are looking at your screen with one eye and also on this webinar screen, because in just about, I guess, 20 minutes or so from now, we should be getting maybe about 30 or 40 minutes from now, we should be getting, the big news. So I guess maybe my first question, and really on this webinar, we have people, audience from across different parts of the world, as Dean said earlier on, about approximately 20 different countries, and a mix of, high net worth individuals who self-manage their portfolios, to fund managers on the call, to retail investors who really know that, whatever happens in the US actually does affect, the global market. Some people might not have direct exposure to US market, but if a number of people do. However, I mean, as we say, when the US sneezes, the whole world catches a cold. And I think right now the US is about to sneeze. I guess my first question to you is around history. So exactly 17 years ago, the Fed made the first interest rate cut after more than 400 days of holding rates. Today, the exact same day, September 18th, the Fed will cut rates after more than 400 days of holding rates. September 2007, the Fed held the rates for 446 days when they cut rates on September 18, 2007. Then interest rate was about 5.25. The same thing today, September 18, 2024, the Fed would have held rates for 420 days. Again, rate cuts will happen today, we believe that, and interest rates will be about 5.25. I guess my first question to you is history repeating itself?
We would not really think so in this particular case. We often like to say history may, we quote Mark Twain, the American author, history may not repeat itself, but it often rhymes. And sometimes in the rhyme can be considerably different, in that in 2007, when the Fed was operating, it was going into the financial crisis. In this particular case, we are coming out of a period of experiencing the effects of having gone through a crisis, responded to the crisis with very low interest rates, and now have raised them, and now are going to trim those from the higher rates that we have now. But we don't think we're going to go lower from here drastically. In other words, we are not expecting to think that we are headed towards 0 to 0.25, which is eventually what happened when the Fed got to 2008, as I recall, is when we got into that zero interest rate and drastically lower rates. And in this particular case, this is not an emergency situation, but rather one to lead to greater normalcy in terms of an interest rate regime supportive of economic growth, at the same time with an eye to keeping inflation in check to avoid a blowback of inflation. Historically, there have been periods where the Fed has cut too soon or cut too much, and you get a blowback of inflation, which simply means all of a sudden inflation proves itself either stickier or higher, and then the Fed would have to come back in and cut. We think raise rather, and we think the Fed wants to avoid having to raise again. They want to drift these rates lower. We don't think they will drift as low as some proponents in the market think, because we do believe they want to keep it in that situation where it's the end of free money, and the interest rate regime is more conducive or more akin to where we've been in history, which would be on a 10-year yield somewhere between around 3.7 to around 4.5%.
Yeah, excellent. Let me piggyback on what you said about too soon or too much. Perhaps there's a third dimension to that, which is too late. So in hindsight, haven't seen the job numbers being revealed in July, or I think early August. Do you think that the Fed perhaps should have made a cut in July? And if so, would 25 basis points actually be a justified cut now and not 50? Because there is a school of thought, in the market and globally, perhaps feeling that the Fed might already be behind the curve. And so the thought dimension to your thought for me is there such a thing as cutting too late? And if that's the case, perhaps 50 basis points might seem more reasonable.
Well, I think that's a very good question, in the sense that, is it cutting too late? And we don't think so. If we look back to that surprisingly low number compared with expectations in terms of the jobs added that occurred, and I think that was the July number. That July number had been likely affected by the hurricane that hit Houston and several southern states across the U.S., and some seasonality that occurs in late summer from the summer job numbers before things begin to pick up in the fall. That said, we do think that the elevation of jobs added during the crisis, and remember, during the COVID crisis, there was great disruption with labor. In many cases, Some people, because of the stimulus packages, actually just quit their jobs and went to early retirement and were able to do that. Some people moved away from different regions of the US and it disrupted the flow. And then once the vaccines took effect, people became more confident and businesses reopened, then there was great demand for people and people began coming back. There were many jobs added. And that, we believe, that elevated status of job growth is likely what has led to expectations or the thought that the Fed might be late here. But the numbers that we are now seeing in terms of jobs added are more normal to what we would see on that monthly basis. And so in effect, it's sort of, we have been in sort of a celebration mode of coming out of the COVID situation. And that's why there were so many jobs being added. And even the JOLTS number from the Labor Department, which is job postings, that's come down. But it still is fairly elevated relative to history. My recollection is if you go back about 6 years, it's usually around 4 million. It's now, the latest was around 7 million, but it had been as high as nearly 10 million at one point. So it's just that coming down, it's as the process of the economy normalizing, and also the addition of greater participation in the labor force as a younger generation comes to work, to the workplace in America. All of this is in change and in flux. So I think the Fed has been about right so far. I think they were behind the curve in March of 22, but I think so far they've judged it right. So I don't think they have to cut 50. If they do cut 50, I do expect that Jerome Powell will give us a good explanation when he meets the press after the release of the announcement.
No, thank you, John. I mean, we sort of like hold the same thought and same line, but one of the things that I believe the audience on this call would really want to get us talking about, and we will get there, is how this really directly impacts, their relative, their respective portfolios, and we'll talk about that shortly. But I think it would interest me in terms of what you think about a potential 50 basis point cut. What does that signal to the market? Because the way I'm looking at it is, it currently feels as though heads will lose, tails will lose. If it's 25%, there are a segment of the market that will be hugely disappointed that the Fed maybe isn't as aggressive as they should be. If it's 50, there's a segment of the market, and this cuts, this including global market, that possibly will feel that perhaps there's something the Fed knows that the market doesn't know. Is there a recession along the way? Are we getting a more harder landing than a soft landing? What would a 50 basis point cut do to the market?
Well, I think, Kola, when you look at the 50 basis points crowd, it's rather a diverse opinion within that. Some of the 50 basis crowd just feels that it's a preventive measure by taking 50 bips now, important to make sure that the lag that usually occurs with changes in monetary policy doesn't catch the Fed as being behind the curve within 3 to 4 months from now. The other side is that they are already behind the curve, and so they need to do it. I think this, if we get a 25 basis point, I think the market, the equity market, could likely sell off, not significantly, I think, but near term, there could be some profit taking by bears, nervous investors, and skeptics of the Fed's action. But I think that would be short term, because then we'd get to see in the next few months if the Fed was wrong or not in that. The other side is the other part of it is that the market has been priced for a 25 bips cut. Even though the futures are looking for 50, the market appears to be set for a 50 bips. It also may just move sideways or sell lower in the near future over the course of the next few weeks as the markets digest the information from a perspective of that, a 25 basis cuts, essentially, they already bought the rumor, so why not sell the news? It's a little complex on that. Now, on the 50 bips, the other side of it is, as you said, 50 bips could indicate that the economy is already in recession, which the data does not show that in our viewpoint, or that the economy is headed into a recession. And so that could be worrisome and would give support to a bearish call on equities in particular. And it would be a boost to the bond market because yields would probably fall further in the process, or would be viewed as falling further in the future with more Fed cuts than we would expect, certainly. But the other side of it would be that the Federal Reserve just felt comfortable at this point when they look at the numbers and are just using 50 bips because they think that they want to ensure against the lag effect in changes in monetary policy and make sure that rates are low enough so that we don't get inflation. I'm sorry, we don't get unemployment numbers rising too fast as the economy slows. They want to keep it around 4% unemployment rate is their target. We've been very much gifted in terms of good fortune in reaching a 3% unemployment level at different points in the cycle. And in the prior cycle for that before COVID. And the reason for that really was shifts as baby boomers were retiring, some of the early retirees and some of those now that have retired. And as the new generation paused before they got back to work during the COVID period. So, you know, it's a complex situation, but from our viewpoint, again, we think the Fed is doing the right thing. And I must say that this is our viewpoint and opinion. It is not a recommendation specifically to any institution or individual, of course, because that's their trusted advisors. They need to discuss this stuff with them who know their goals, objectives, and their tolerances to risk. But from our viewpoint and our experience in the market, it looks like the Fed has done a pretty good job, and that where we're headed is, you know, by the way, we can live with a 50 bips cut. We don't think that, because we don't see it as meaning there's trouble. We just think the Fed is just allowing for the chance that the lag effect in monetary policy requires a 50 bips. But at heart, we think this is a 25 bips.
All right. Well, the jury's out. Dean is keeping an eye on Bloomberg terminal, I guess, or whatever news platform. In maybe 25 minutes, we will get this. I can't believe we're having this webinar on this day, John. You know, it's quite interesting. That's such a big, you know, historic news is happening, and we're here just having a normal conversation rather than just being at our desk and managing funds.
Oh. You know, I was yesterday. I was on Asian TV after we spoke. One of the channels that broadcasts over Asia, and the anchor was talking about the historic cuts that we've seen so far this year. And the remarkable thing was when he showed them on his slides was how many had opted at a first cut at 25 bips. Sort of almost like fashion, you know, it's like a wider tie or a narrower tie or no tie at all. It's and market has its fashions. You learn that, you know, over the years. It's like you're amazed sometimes the little things that move the market. And then you have traders and you have investors. Traders are looking always for the short-term play. They are effectively very open to view and really looking for quick money gains, and they provide liquidity to the market. While intermediate to longer term investors, 3, 5, 7 years and longer out, tend to benefit when we get pullbacks, because that's when you find what we say are babies that get tossed out with the bathwater, essentially good stocks that get caught in downdrafts that suddenly you get a deal, you know.
Yeah, and really we've had many of that over the last few months, particularly during earnings season, where all of a sudden good news became bad news and bad news became good news, right? So
Sure.
We're hoping that's not going to be the case after this cut.
I hear you.
Yeah, but anyway, you know what? Let's look. The news is going to be out. We'll deal with the aftermath. But let's get into a more, maybe a more exciting part of this session, which is around new opportunities that really have come out over the last over the last couple of years, as we've seen rates go up, interest rate coming down, and all. And I wanted to focus on two main areas, but I mean, feel free to maybe add other areas that you possibly have seen. But just before we start this conversation, again, for those that are just joining us, welcome. We are having this webinar, which is Opportunity Insights webinar, on a very, 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 special day. We're expecting a big news from US Fed. This is going to affect all all global markets, that have any kind of exposure to the US, even otherwise. So fund managers on the call, we welcome you, and retail investors, welcome to the call. It'll be great to hear where you're joining from. So in the chat, using the chat box, just tell us where you're joining from. I've seen some people from Zambia, from Nigeria, from the UK. So just keep dropping where you're joining from. And then at some point, we would entertain a few questions from the audience as well. So use the Q&A function to also drop in questions there. John and I would attempt to take both of them. Right now, I've got John on the hot seat. I'm just coasting along with him, doing all the hard work. All right, John. So let's talk about opportunities. Two areas that I've seen that became really, I would say, the driver of the US economy, and that sort of like also positively impact the rest of the world. And I would say perhaps what really prevented, one of the things that prevented the US economy from going into recession, AI. Artificial intelligence has become such a big theme in the market. And we've got the leaders of the market that I'm sure you know, the NVIDIAs of this world, Broadcoms of this world, and co. And then you then have the hyperscalers who now are investing billions of dollars in actually building, data centers and technology for generative AI. And we've seen incredible growth over the last couple of years in terms of, return on investments for investors across this space. That's one opportunity. And then the second one that we've seen is private credit. We've seen the rise of private credit over the last 2 years. I mean, literally from 2020, growing from just $40 billion to $1.2 trillion Q3 2023. And I think it's currently about $1.5 trillion in private credit. Now, of course, there are other opportunities that you're seeing. So I guess, John, what I'm trying to get to here is where are we? What opportunities do the events of the last 2-3 years really have created for us? And given where we are right now, where do you see artificial intelligence going? Where do you see private debt going, and everything else that you possibly have identified at Oppenheimer as well?
Great. Wow, that's a detailed question. So you'll have to guide me as I go through it if I miss any of components, because they were all very good at components. The first is related to artificial intelligence. Artificial intelligence already is within the business community to a great extent on a relatively primitive basis to where we're going, is what is being seen here. And we think that in the last 2 or 3 years, one of the reasons why we were able to maneuver through the back end of the financial crisis, the uncertainties of coming out of that into the COVID period, which created other uncertainties, was not only the experience that business people and federal and monetary policy officials were getting from all this, because experience can be very valuable, but being aided by technology. And when I started in this business, I mean, it was really a very primitive thing when we look back. My first desk had a Quotron or a Bunker-Ramo machine on it, which were effectively just quote machines. You have a little bit of news on. They were not even a PC, nothing like the computers of today. So information is a lot easier to get today. There's also risks from social media, unvetted material, and things like that. But generally speaking, the level of information that flows through the world is remarkably good, and technology delivers it. And knowing what's going on, being able to analyze situations, allows individuals and corporations, both business and consumers effectively, to navigate situations a lot better than ever before. And that, of course, happens very often. It happened originally with the development of the PC, then the laptop, then the smartphone, all these things. And now AI is what makes all that hardware and the software has the potential to make it much more effective, quicker. It can happen for all of the 11 sectors that are represented by the GICs of the S&P 500. I know we're going to talk about that later, so I won't get into it right away. But we think that where we are now is essentially a watershed moment on the history timeline that likely, we believe, is parallel to where we were when in another era, long before I was born, and it would be the period where in the early 1920s, just around better than 100 years ago, after Henry Ford had mechanized the assembly line, brought down the cost of the automobile and raised the quality, making it more affordable to millions of people. And it changed the way businesses executed, how individuals lived. We think this technology, and it will require, we believe, AI, there will be AIs that similar or parallel to VPNs will be certified different levels, but will help. It'll help, whether it's medicine, whether it's energy generation, designing products, what have you, and education, and for managing government policy and corporate decisions. This is really, it's that we believe it's a watershed moment. Now, related to private credit is, in our view, very much an outcome of technology. It is, it's fintech, essentially. It's a product of fintech, and private credit has enabled many smaller corporations and lower grade quality corporations to be able to borrow when traditional lenders wouldn't finance projects or finance a restructuring. This is something that is relatively new. It's the other side of private equity, is private credit. And we think that as we go forward, we will see private credit will likely come under greater scrutiny by government entities around the world. In the US, they're looking for more regulation, but more regulation does not necessarily mean that it will stifle the growth of private credit rather, but will rather increase the use of it. And it provides competition to traditional lenders. So we think that's part and parcel of this new era, and it's certainly one in which AI will likely play a role to make these smaller operators, to help them grow into becoming bigger private credit operations. They're already huge private credit operations, but the other ones that are coming up, and it will likely create a more competitive lending market, which may very well lead to greater productivity on regional basis around the world.
Fantastic. I mean, we share the same sentiments. I mean, when I hear Jason Wan talk about AI being another industrial revolution, I actually believe so. I deeply believe that the next 2 decades of our lives are going to be hugely impacted. I hope positively, and more than negatively by AI. But I think maybe with that conversation, maybe let's start to get deeper into global assets and portfolio impacts of today's Fed news, and also the opportunities that you're seeing. So, John, I mean, given how the Magnificent Seven led largely by Magnificent One, I would say, have done over the last over the last year plus. I mean, not all of them in the basket, but at least the top three, top four of that literally carried S&P 500. And then now we're moving into a space where small caps would most likely benefit from major cuts that are that we're going to see over the next few months. I guess my question is, for an investor on this call, retail fund manager, investment advisor, and we have quite a number of those on the call right now, who's thinking, how do I go about constructing or reconstructing my portfolio over the next few months in order to absorb the shock that might happen or the opportunities that might be created?
Well, that's another great question. And here's what I would say to this. We're big believers in diversification. So while we think that technology is in the lead, it is the innovator. In the case of the S&P 500, for example, the sectors are information technology, financials, communication services. Now, communication services is very heavily tech related. It's search engines, it's streamers, and it is also social media stocks are the main components within it. But then you have real estate, industrials, the industrial sector that is power generation, that is aerospace, defense equipment, that's robotics, that's agricultural equipment. There's another sector, utilities, which is the production of electricity, however they source it, and upgrading grids for this new era. Then there's a consumer discretionary, which is all kinds of things related to consumer activity, not just retail stores, but a lot of different types of things. We'd also say consumer staples, which in the old days we used to call Cokes, smokes, and soaps, or that kind of thing that people can't do without even in a recession. Healthcare, materials, and energy. When we look at all those sectors, what's very interesting, if you look at, you mentioned a Bloomberg before, if you go to a Bloomberg, if you dissect the S&P 500 into sectors, if you look at it from the, and I'm looking at my Bloomberg right now when I turn my head, so bear with me a moment. If you look at it from the October low of last year, which would have been October 27th, what you will see is the S&P 500 is up about 36.87% in just basically a year, just about a month short of a year, right? Infotech is up 48.6%. Financials are up 43.56%. Wait a minute, that's not technology. That's a technology user. Communication service, heavy tech related, is up 41.39. Real estate, a section that is very concerning, it's up because of some big buildings in big cities, the work from home versus work at the office kind of thing, and buildings that are not adaptable to modern technology needs. Real estate's up 38.48. The industrials are up 36.74. Utilities are up 33.49%. And consumer discretionary, 31%. Staples up 26.84%. Healthcare, 26.36%. Materials, 24.54%. And only one sector is really lagging badly, and that's energy, up 3.51%. And some of that is related to, ironically, all the geopolitical risk tied to the Middle East, as well as to the war in Ukraine and the sanctions and all, has actually turned into a more combined with the problems that China has right now in its economy related to growth. All of that is impacting the price of oil and the price of oil stocks, and that's the only one that's down. So I would offer, we've already seen a broadening of this rally as it's evidenced in the S&P 500. We would think that now, as we see the Fed actually cutting rates, that we might likely see the rallies that we have already seen in mid caps, the S&P 400, small caps, the S&P 600, which is a higher quality small cap index by design. I think the design is they have to be profitable by a year to be admitted into the index. And of course, the Russell 2000, which is the small cap go-to for many managers. It's been mentioned quite often in the press that 40% of those companies are likely unprofitable. And that's very possible. But you've got to remember, some of them are just small companies that are starting out, that it's not the quality of the company, but rather it's just their newness. They're still getting to a point of looking to get positive cash flow, looking to get profitability. And then some are deservedly just basically the kind of stocks that only go up when the tide comes in and all ships float. But we think small and mid-cap stocks are likely to begin to experience sustainable rallies compared to the short-lived rallies that we've seen leading up to a Federal Reserve cut. And so we think that that's something for investors who are looking to diversify more broadly may want to look at. Both from a perspective, mid caps tend to be those companies that have done so well. They've left the small cap realm, moved into the mid cap, and you look for those, the better ones will graduate to likely become the new large cap companies.
Awesome. Wow. I mean, I hope everyone got something out of that, because there you have it. There you have your not financial advisory, but some kind of insight into what direction we could potentially see the next set of gains, given how much rally we've seen with S&P 500, even NASDAQ and co have done really well over the last few months. I guess maybe that then takes me to my next question around global assets. I know your experience goes beyond just the US market. Yep. So Asian market, Europe, perhaps Africa as well. Do we potentially see this in broadening out into global market as well, in terms of either rotation of capital? There's a lot of cash sitting on the sideline over the last few years. Do we see that coming into emerging markets, and what specific areas are you seeing through Oppenheimer research beyond?
This is certainly a point that is well taken. The emerging markets and the developed international markets, particularly for U.S. investors, because of the strength of the U.S. dollar over the course of the last decade, and what made the dollar strong was the level of risk, in the sense that the dollar was ultimately the currency of the world, not just the reserve currency of the world, but also a safe harbor currency, it was thought in many ways. As the world, and first of all, as the Fed begins to cut rates, it is likely that the dollar will weaken, not because something is necessarily wrong with the U.S. economy, but because our interest rates will come down, making our fixed income less competitive to foreign fixed income in terms of yield, okay? In the other sense, too, is normally when the dollar comes down and the Fed begins cutting rates, you experience all of a sudden, it's almost a relief sigh from the emerging markets, because that's generally they begin to benefit at that point. From a demographic point of view, from a point of development and growth, we think both emerging markets and international developed markets stand to benefit very much from the normalization of interest rates. And in the process of that, we also think they stand to benefit from what has come as a global diversification away from one country's centricity dependence on a supply chain leading to just one country. And so we think this is a marvelous opportunity for many emerging markets, for frontier markets. We think the process and affordability of technology on so many levels, with AI on the verge of getting distribution and greater affordability there too. We think there's a lot of things that are likely to develop very positively in the global economy. And you travel around the world today, and if I've been 41 years in this business, you can remember, you got to figure I've had quite a few decades to travel, both for business or as well as a youth, and the cities all look decidedly different. The cities are so much taller, they're so much bigger, there's so much business, and a lot of that was empowered by the technology that came out of the PC, the laptop, the smartphone. And, this keeps going. The big thing about technology, the tech bubble was primitive when we look back to it. It was the internet and new companies that hoped to gather 1 million eyeballs someday and become profitable. Some of those succeeded and became the giants that are in the Mag 7, okay? But a lot of them went by the wayside. We believe this period has much greater sophistication, heavier competition, so that a lot of the wheat can be separated from the chaff very quickly, or at least at a faster pace than back then in the tech bubble days. But we think it's a real opportunity. The hope is that governments around the world, and that includes the U.S. government, will be positive proponents of business to help business establish a platform from which we can see populations around the world benefit from this.
Fantastic. Wow. John, we have 2 minutes or so, or 3 minutes to the big news.
Yes, I'm glad you were watching here.
Yeah, I am watching. I'm sure Dean is watching. I'm sure everyone is watching. So it's exciting, but while we're watching, and so the next 2 minutes before the news comes on, we cannot but dive into politics. And I hate to bring this up, but we have an interesting couple of months ahead of us with the US election. I'm sure everyone on the call also will want to see, what that looks like. And really it's from the policy, not from a person perspective. Look, I don't have a vote, you do. But I think what are you thinking along the policy lines of the two candidates, and how does this one again impact the US market and by extension global markets?
Oh, great question. And as we're getting close to this may be interrupted what I'm going to say when we look and see the number of the cut, but we'll follow through with this. First of all, as chief investment strategist at Oppenheimer, when I speak on an official basis, I speak politically agnostic. So I offend all sides, liberals, conservatives, everything between.
You make a lot of enemies. That's the best way to live, right?
It's because I have to see it the way I do as a strategist, and I am most certainly a capitalist and one who believes that business builds prosperity and business creates better environments for all people. I think that where we are, the biggest concern of both candidates is both want to spend a lot of money at a time when the U.S. is already extended related to how much debt we have outstanding and how much we need to fund versus, I love the way they call taxes revenues, right? It's called taxes since the beginning of time. The Roman Empire didn't say, these are the revenues that you need to produce. No, they said, these are your taxes, okay? I'm just watching that screen. So anyway, when we look at this, what we've got to think is that'll have to be addressed after the election and let's see, it looks like, let me just see, it looks like
What do we-
we're at
what-
5.25 to 5%, and we were at where were we? We were at the actual, it came down, let me just see, we're at 5.
All right.
We came down 50 bips.
50.
That's what it looks like to me. I'm
The
looking
big news
here.
is here.
The survey,
What-
oh no, the survey was for 5.25, came
Yeah.
in at 5%.
Interesting.
I'm looking at that. Hold on a
okay.
second. I'm just looking. The lower bound is, the upper bound is 5.25. It went to 5, and the lower is now 4.75. So there you go.
4.75. That's
Yes, 50 basis points.
Yeah,
wow.
that's it. So that's, I think we'll have to hear what the chairman says, what made his decision. That I would have taken 25, but I defer to the, I'm sure he could care less, but I defer to the chairman of the Fed.
All right, there you go. Breaking news, ladies and gentlemen, 50 basis points. Whoa. All right, so let's get ready for what, what the next few hours will look like and tomorrow.
And let's take a look, and when we look at it, if I take a look at the, let's see, if I go look at the, it looks like, if on my screen, on my Bloomberg, it looks like the S&P really liked it. Now it's beginning to kind of judge it. It slipped a little bit from the peak it jumped up to, but it looks like the S&P said, "I like it," just like a television commercial for a hamburger.
Yeah, I think it really does like it, because I'm seeing S&P up. What's Nasdaq saying?
You can see what the
Yeah, sorry guys, breaking transmission. This is why we're part of why we're on this call. It just happens to be happening right now. So
and the Nasdaq took off as
likes
well. It's off its peak though, where it jumped to. It spiked, and then it looks like it came back. It's up
Yeah.
almost a point right now. I'm almost 1%, 0.95%.
Yeah, so Nasdaq likes it, S&P likes it, Dow likes it, Russell likes it, VIX is down, expected. Yeah, so this is interesting. Okay, so John, there you have it. What do you have to say?
Well, what I have to say is, as I mentioned, they said I'll take it if they do it, but I would have gone for less. I would have doled it out. Perhaps I'm too conservative on that. I look and see I'm just looking to see what the mids are doing. Let me just put, I got another screen on here.
Right. Sorry, everyone on the call, what do you think? We got 50 basis points. What do you think? How does this, what does this mean for your portfolio, for the fund managers on the call that have exposures to the US market or global assets, individual investors? What are you thinking? 50 basis point. Economists wanted, I think they wanted 25%, so 25 basis point. The market wanted 50, the market got what the market wanted. Economists didn't get what they wanted. So John, I think you're sticking with the economists on this one.
I'm looking at this, and right now, from what I see on the S&P, it looks like energy is up 1.2%. Industrials are up 1%. Consumer discretionary is up 0.9%. Real estate 0.7%. Information technology up 0.7%. Healthcare up 0.65%. Financials up 0.33%, less so. Communication services up 0.21%. Consumer staples, a defensive sector, 0.2%, and utilities down 0.31%. So if anything, it does say cyclicals over defensive. So I'm good on that call. And I got industrials and consumer discretionary and information technology, 3 out of my 5 favorites in the lead. So I feel good about that.
Awesome. You still, heads you win, tail you win. So
yeah, that's the thing. I didn't change my allocation, you see, but my bet was on just the bips. The traders won.
Yeah, traders won.
And they're
Awesome.
showing it.
I mean, And risk, I mean, risk assets is going absolutely off. I'm looking at same thing with digital assets, all up. I mean, this seems like good news for risk heavily. So risk is on. And could I then say perhaps in terms of what JP Morgan had forecast, had a forecast of I think 125 basis point, 125 basis point by end of year. Do you see that happening?
Well, let's see. This is 50, and I'm looking for 2 cuts at the end of the year of 25 apiece. So I'm looking for 100 bips cut. But based on this, the indication is the Fed could well cut, by a total of 125 bips by the end of the year.
Okay.
You would think that, but I'll stick with my 100. I'll stay conservative for now.
Yeah. Okay. All right, John. So, I mean, let's start to bring this conversation home. We want to start to take some questions outside of you and I, but I wanted you to land the conversation on the US politics side of things. And Dean, after that answer, we then go into Q&A, where we then take some of the questions that we're seeing from people. I do have a question here already around FOMC. So, I mean, election November, what does this mean for the market and global assets?
Yeah, I think very much is in the US, what we've noticed is over the years, historically, going all the way back to Harry Truman, is overall the Democrats have been better for the stock market than the Republicans by a small margin. And some of that is driven by the fact that sometimes the Democrats are elected after a recession. And so they come up, when Clinton came in, we'd had a recession and he came in for the recovery. So that helped Clinton. It worked similarly at different points over the years. Going back, we have a chart that shows that. Off of the top of my head, I don't recall, but it's overall it's about a 9.75%, as I recall, average annual return over the period for Republicans, and about a 10 or 11% for the Democrats. But there are times when the Democrats don't drive the market as high as the Republicans. It depends upon policy. But the market itself is very, very practical. And the market is going to sigh a sigh of relief on the day after the election day, or if there's any question that about, they have to count votes that have been mailed in or whatever. When they have a final tally of who's won, the market breathes a sigh of relief. That uncertainty is out of the way. And then it will say either, what do the Democrats buy? Or they'll say, what do the Republicans buy? Essentially, what does the administration spend money upon? What sectors does it favor? And the market adjusts. But the most important thing for the markets are revenue and earnings growth. So that goes to how does the policy work that the administration adapts, and how does that affect the economy? Because ultimately, revenues and earnings are driven by economics. Sometimes innovation can drive the economy also. And in this case, we've got both innovation, and right now the Federal Reserve has given us a very good underpinning in terms of growth from over the course of the last few years. And right now it looks like they've just, at least for this day, we'll have to see how the market digests all this once market participants ponder it in the next few hours and over the course of the next few days.
Yeah.
But ultimately, it's October 11th when we start going into the third quarter earnings season, and we'll have to see the way earnings look then and what the projections look like for the fourth quarter.
Yeah, fantastic, John. I mean, so this is our own conversation. I think I just want to assume that our audience has been writing down, particularly around some of the key things you said around new areas of opportunity in terms of sectors to look at. And now that we have the news, And we're already seeing now, right now, that, cyclicals will most likely possibly lead the way over defensive. So really just also seeing that with your portfolios as well, and the rotation into small and mid caps. Those are very good things to just take away from here and start to sort of like see which companies, if you're not buying the indexes, which companies within there most likely will lead the indices. I hope you're seeing that as well. And then, of course, our fund and our company is focused on alternative investment, meaning that our exposure actually goes beyond, equities and all into, commodities, digital assets, private debt, private equity, venture fund, as a portfolio of alternative assets, which makes our fund sort of like ideal for those who don't want to, self-manage, and they just want to have a basket of all of these different things and it's managed on their behalf. So Dean, let's go into Q&A. I just wanted to see what do we have for John and I from any of the questions. Let's go ahead.
All right. First, I just hope the audience sort of took note of how it is, or it can be stressful to be an investment strategist or investment manager when you've got major news coming. You could see, John concentrating on the screen there, KO as well, looking at digital assets. I mean, we live very interesting times, and sometimes I know a lot of people may not fully appreciate the immensity of the moment when you have times like this. So, I mean, thank you, Kola and John, for the discussion as well as your reactions in that moment. We're going to dive now into the Q&A session. And the first question is going to come, it's about the efficiency of developed and frontier markets. I'll push this to John. Having in mind the issue of information asymmetry, do you think the Fed or the FOMC has measures in place to prevent dissemination of their decisions before release to the market?
Oh, I think so. I think that there's very little leakage that I can recall. If there was any leakage in terms of the Federal Reserve, I can't recall a time when they've had, that would be similar to inside information. And the Fed has been remarkably good. I think that the Fed, if anything, because of the fact that it has been so open about its policy changes, and it was thought here before this that the Fed chair was thinking of a 50 bips point cut. That was fairly intimated by everything that they said before the quiet period ahead of this. I think, the traders got it. The traders read it right, and there we are. That's, but I don't think that this was leaked to the market. I think what the market has been seeing is you have both essentially the resilience of the economy, but also the success that the Fed has had thus far in bringing down the levels of inflation, even though the 2% target for inflation remains somewhat elusive. On some measures that it looks at, its favorite measure, it's around 2.5%, and some headline numbers, it's a little bit higher than that. So there's still a ways to go, but apparently the Fed feels comfortable, and there we are.
Okay. I'll sort of bring that question to KO as well, but not looking at the FOMC, but looking at the, African monetary authorities. What do you think of this same question with regards to information asymmetry and whether central banks on the continent have measures in place to prevent dissemination of their decisions, KO?
So I think largely, depends on, we can't speak for the entire continent. So I think it depends on which country you're speaking to specifically. So we have seen cases where, some information got out before official ones actually got out. But I think largely, for the more mature markets within the continent, we've seen relatively, information guarding being effective over the years. I think what I'm really more concerned about, it's really more about the impact of whatever information comes out. Right now we're sitting, John is in New York, I'm in Lagos, you're in Kenya, and different people are, you're in Nairobi, and different people are in different parts. And I'm watching the US Fed, US Fed's major news today and really just jittery about potentially what could happen with a 25 or 50 basis point and what that means for our portfolios, right? Now, if a central bank governor is releasing some kind of monetary policy somewhere on the continent, how many fund managers actually pay attention to that information, and what impact does it really have on the market? And which is why I work in ensuring that we really build and develop the market to the point where it's information driven, is information and data driven, and extremely important. I don't get the same impact as we see from perhaps European, central bank, ECB, Fed, or even Asia. I don't get the same effect on the continent, and I would really like to see that change and improve.
Thanks, Kale. John, let me circle back to you. So we now know the Fed's has commenced its easing cycle with a whopping 50 basis points. So how should institutional investors weigh the risk-reward trade-offs between higher growth but volatile emerging markets? So your Latin America, Asia, Middle East, maybe even you can extend it into Africa. How do you weigh that risk-reward trade-off between higher growth but volatile emerging markets and safer, lower-yielding developed markets like the US?
Well, Dean, I would say for professional managers, much of their actions are tied to their mandate in terms of their funds that they manage, which essentially is what is their mandate, is essentially under what parameters of risk do they operate under. And similar for advisors to family offices and individuals, private individuals, they have to consider the experience and tolerance to risk, goals and objectives of their customers. So I can't really say. I can say to you from my perspective, what I'll be watching are several things. One is I'll be looking to see the market's reaction to today's cut over the next few days immediately, and then over the course of the next month and or two, we'll be observing what the inflation numbers look like as we going forward. Do we see that this is having any positive or negative effect on inflation? Are we going to grow faster than we inflate? Is the inflation level going to stay low? Those are the questions that I would look at and consider within that space, the balance between what not only the FOMC rate is, but how the market prices yields beyond the short end of the curve, because the short end of the curve usually reflects where the Fed is in terms of the Fed is tightening. That's where you get your risk inversion from, the front end being higher than the more longer maturities. But now, this is prospects for a more traditional, I would think, yield curve to develop and become more sustainable. From a point of view as a manager on a global basis, and from the U.S. perspective, a dividend growth manager, I look at this and I think 50 bips cut is based on the way this Fed has acted, which we think is very responsible and sensitively. I'll take it, and we'll work with that, and I don't see it as at this moment. I'm not considering making any changes at this point, though I always reserve the right to.
Thanks, John. I sort of want to stick with that theme. So you've seen the 50 basis points. If I can look at the dollar, you're seeing further momentum lower. If you're looking at the DXY, that's already given up quite a lot of gains from around the middle of May into June. So it's quite clear that, the outlook for the dollar here is, dollar weakness into the next few months. And I sort of want to pick your brain in terms of, whether you think, it's a great time for local currency denominated, opportunities in emerging and frontier markets.
I would have to think that this shows improvement, and the market is telling me that if I look at my Bloomberg screen, whether I look at the ETF that tracks the MSCI emerging index with China, or the emerging market index without ex-China, those are up nicely. With the emerging market ex-China, looks like it's about 0.88% at this moment on my screen. The one that tracks the emerging market at this moment looks like it with China looks like it's up 0.54%. So it would say that that where the market is tracking, or how traders are buying this right now, would seem to me to be saying that as would have been expected, the dollar lower, emerging markets doing very nicely in here, and IFA is up about up 0.58 on this screen right now, and the hedged version of each IFA, currency hedged, is slightly lower, down around 0.09%. So it looks like today the market is saying the dollar is likely to stay weaker. But that on a day-to-day basis, as we all know, currency and oil traders are very similar to what farmers in Texas say. If you don't like the weather, just wait 10 minutes or so.
I like that. I think that's directly to Dean. Let me just wade in on that very quickly. Every single time we see a weak dollar, there's generally benefit to emerging markets, and typically around 4 or 5 areas. Lower debt burdens, because many of the emerging market debts are denominated in USD. So when dollar weakens, the cost of servicing the dollar and repaying the debt decreases, slightly or exponentially, depending on how weak the dollar is. And then there is, improved and increased capital inflows into emerging markets, because capital chases opportunity. So a lot of fund managers like John, myself, take, USD from wherever we can find it and take it to emerging markets, for investments. And the third thing is really, obviously, currency appreciation for emerging markets when that also happens, because a weak dollar leads to appreciation of emerging market currency. And this generally also leads to, boosting purchasing power. Inflation rate becomes lower. So for me, as a fund manager, when I see a weak dollar, I start to look at markets where we look at India, look at Nigeria, Kenya, China, literally, and see countries that potentially could offer some opportunities in terms of investments.
Thanks, Kel. I want to stick with you because I want us to talk about digital assets for a bit. We now have a 50 basis points cut. If you look at Bitcoin in particular, or crypto, it's been pretty range bound over the last few months. Do you think we're finally going to get some momentum for Bitcoin and crypto in particular? I can already see Bitcoin is at around $60,000, but over the last week, 2 weeks or so, it has broken past $60,000, but struggles to stay above $60,000 sustainably. Do you think this rate cut is going to finally provide that fuel so that we can see a proper run into the end of the year in terms of upward momentum for crypto and digital assets?
Related to cryptocurrencies, we really don't favor cryptocurrencies at this time. We haven't since the beginning. I can remember not liking crypto initially because we favor sovereign or fiat currencies that have a government standing behind it, so we know what the accountability is. We know who are the participants at. We can't help but think, pardon me a second, I'm going to try to turn down the volume on this phone that's just taken off. If I can do that. There we go. Let me take that down. There we go. What I would say is this. We think there's several things that have moved the price of crypto to the upside over the course of this year. What it has been is in the U.S., as you all know, and around the world, but in the U.S., when we look at the market, people love to gamble on their smartphones. Bitcoin, in our view, is not supported by a lot of fundamentals. That said, we also think that a lot of Bitcoin's popularity has been to purposes of moving money out of troubled regions around the world with less ability for detection. So we think Bitcoin is creating a new gray economy in many ways, in our observation, as most currencies around the world are very less and less use of cash and more trackable by use of the credit card. The credit card is really the progenitor of digital transaction, if you consider electronic and then moving into digital. What we do like about the Bitcoin story was the blockchain mechanism, which can be applied to so many transactions in many ways, making transactions faster and improving and lowering the cost of transactional issues. But when it comes to Bitcoin, I really can't give you an opinion on that is positive.
No, I mean it's fine, but that's what's great. That's what makes a market. I'm going to pivot to KO as well to give us some thoughts on that.
Yeah, I mean, so I can see we're almost running out of time boundary. So I'm just going to keep it very short. And then yield it back to you. So I think, I mean, to John's point, every new innovation tends to always have its dark side. I mean, we spoke about artificial intelligence earlier on, and we do know that AI also has some very major dark side to it in terms of, racial profiling, algorithmic, suggestive messages to kids on their mobile phones. I mean, there's just a lot that AI could also do in terms of quote unquote evil. And so when you look at the entire sort of like cryptocurrency space, the same way I believe that, every new innovation has that dark side, it also has its own. But perhaps to John's point, what I'm most excited about is the technology, the underlying technology behind it, which is really that enables so much more to happen. Blockchain enables intercontinental payment, seamless payment being done. You have, healthcare systems, decentralized databases being made possible by blockchain. So all of those things are really very, very, for me, in terms of innovation, very important. But to your point, as an asset class, I think we saw something major in January this year when SEC actually approved the first Bitcoin ETF. And I think, the Ethereum ETF also has been approved. And so it really doesn't matter if I like it or I don't. There are investors out there who really have decided that, they want it as an asset class, just the same way they want, companies. The same way they want to own companies as part of their portfolio, they also want to own digital assets. So Bitcoin ETF, for just the sake of record, has attracted more capital inflow into that ETF than any other ETF in the history of ETFs. And that says a lot in terms of what people want exposure to. So I do believe that feature is there. Do I believe in it as an asset class? Absolutely. I believe that perhaps in the next 5-10 years, the way we make payments would change completely. The more regulations we have in the digital payment space and digital currency space, the better it becomes in terms of being able to actually have legitimate transactions with, digital assets, especially Bitcoin. So that for me is very important. Do I believe in it as a store of value? I also do. I do believe that over a long period of time, it could be equivalent to gold as commodity in terms of, asset class. And there's a whole new generation that doesn't want to store value in gold, but they want to see Bitcoin as their own digital gold. So yeah, that's my personal opinion, by the way.
Alrighty.
All right. Thank you so much, John. Thank you, KO, for that final thoughts on digital assets. Pretty wide, but like I said at the start, it's the divergent views that make a market. Before we wrap up, I'd like to extend a big thank you to everyone for joining today's insightful discussion. Your engagement through the polls, as well as the Q&A, as well as the chat has been fantastic. And we hope you all gained valuable takeaways for navigating what's coming ahead within global markets. I'd also like to thank our panelists, Kola Oyeneyin, our CEO, John Stoltzfus, Chief Investment Strategist for Oppenheimer. I really want to thank them for sharing their expertise on how today's market shift will help shape investment opportunities across sectors as well as across different regions. Before you go, a quick reminder to everyone, we will feature a short video titled Capital Meets Creatives, after which the event will end. When you leave the event, you'll receive a link to a survey. We'd really appreciate it if you could take a moment to fill it out. Your feedback will really help us improve future sessions and continue bringing valuable content to our network through this series, which is called Opportunic Insights. You are able to view more about Opportunic on our website, www.opportunic.com. Thank you once again, and we look forward to seeing you at our future events. Goodbye.
Thank you, John. Thank you, Dane.
Thanks very much. It was great.
Bye now.
Capital meets creatives, an intimate event where investors will gain insights into the needs of creatives and understand the structural gaps in the creative economy. Creatives will learn about funding requirements, showcase their challenges, discuss business structures, and identify investment opportunities. This event is designed for filmmakers, music artists, beauty and fashion entrepreneurs, digital creators, and structural enablers. Capital Meets Creatives is brought to you by Opportunic, Africa's Global Fund, and Volition Cap, the largest funder of the Netflix #1 movie, The Black Book. RSVP now